Hello friends. So far we have studied a few basic terms that are associated with the field of accounting. In this video, I'm going to introduce you with what is the base of all accounting. Suppose you have bought an asset, say a motorcycle, and you promised the supplier that you will pay for the motorcycle in say 2 months. So, in the current day, you have the motorcycle in hand. That is your asset. You own an interest in it. But simultaneously, you also have a creditor. That is the supplier to whom you have promised to pay in the future. So, that increase in asset has also resulted in an increase in your liability. See, next example, you are going to start a business. For the purpose of business, you bring in 50,000 rupees cash from your own pocket. Now, for that business, the 50,000 rupees is an asset. That is, the business can use that money to run its operations. But simultaneously, since you have brought in cash for the purpose of business, you now own an interest in it, which is known as the capital, which we have studied about in the previous videos. So, because of this transaction, there is a simultaneous increase in your asset, that is cash, by 50,000 rupees. Also, you have an increase in the capital by 50,000 rupees. So, we see that in both the transactions, at the end of the transaction, the asset is getting equal to the liabilities. That is, the total is balancing out. Any increase is resulting, any increase in asset is simultaneously also resulting an increase in the liability or the capital. That is the basis of accountancy. This is known as the accounting equation. That is, all the assets will be equal to the liabilities and the capital. Now, what is the importance of this? This equation sets the foundation of the double entry accounting system and highlights the structure of a balance sheet. Now, what is double entry accounting system? It is a system where every transaction has two effects. Say, when we purchased the motorcycle on credit, it had two effects. One, it increased your asset, that is the motorcycle, and another, it also increased your liability, that is the creditor to whom you have to pay in the coming future. When you brought in cash from your own pocket to the business, it had two impacts. One, it increased your assets, that is cash, by 50,000, plus it also increased the capital set. This double entry accounting system is the foundation on which all future lessons will be based. It might seem confusing right now, but as you will progress with this subject, you will get to understand this even better and realize how important this is. Next, it is mentioned, it highlights the structure of the balance sheet. So, what is a balance sheet? A balance sheet is prepared by every business at the end of the accounting period to show that how many assets and how many liabilities the company is having. Say, the company has cash worth rupees 20,000 and stock of 50,000. So, the total asset is 70,000. Then, it has a creditor of say 10,000 and capital of 60,000. So the total liability side will also be 70,000. This categorization is prepared in the form of balance sheet. We will study about what is a balance sheet and the structure of it in detail in the future. This is just to give you a taste of it. Then, what does asset represents? Asset represents the resources that is controlled by the company. That cash belongs to me, the motorcycle belongs to me, while the liability represents the obligations. Because of those assets we control, now we are having an obligation to pay to the creditors. Equity is the owner's interest. So liabilities and equity show how the asset is financed. Say when you had cash of 50,000 which you brought in from your own pocket, then that asset of 50,000 was financed by you. So that capital of 50,000 represented that the cash has been brought in by the owner. See, similarly, when you bought the motorcycle of 20,000 on credit and the liability was there in your balance sheet, it represented that you bought that asset, that is a motorcycle, because of which you now have a liability. So that asset is actually financed by a liability which you will have to discharge in the future. So this is what the accounting equation represents: how the assets are financed by way of liability to third parties or by way of capital, that is the owner's interest. Now, what is the limitation of it? The accounting equation only tells you that okay, you have 50,000 of an asset, out of which 20,000 is liability, that is your obligation to third party, and 30,000 is your capital, that is the owner's interest. But it does not give you any interpretations on its own. You have to interpret those figures. The balance sheet will always tally, but it does not provide investors as to how well a company is performing. As you progress with the subject, you will see that you have to maintain a balance between the liability and the capital. That is called debt and capital ratio, and so on. Each of these elements is very important and determines if your company is performing well or not. All these understandings is not provided by the accounting equation in itself. The investor has to interpret the number and decide for themselves whether the company has too many or too few assets, whether it is financed properly or not. This whole lesson might seem confusing to you because we have just started with the foundation of accounts. As you'll progress, this will become clearer to you. You can just take from this video that in accounts, the assets are always balanced with the liabilities and the capital, because every transaction will have two effects. It will either increase your asset and increase your liability, or it will increase one asset and decrease another. We will understand this with the help of a question which is there in the next video. Hope this lesson is clear to you. If you have any doubt, you can post them in the comment section below. Thank you.